Good morning. My name is Laura Petersen. Today I will be talking about ethics, controls, and reporting, the top 3 fraud prevention measures for business organizations. I am going to establish that financial fraud in small or family-owned businesses can be reduced, prevented, or detected through the application of an ethical corporate culture, appropriate internal financial control procedures, and an effective anti-fraud education and fraud reporting program. Fraud is an act of wrongful or criminal deception intended to result in financial or personal gain. The 3 main categories of fraud are asset misappropriation, corruption, and financial statement fraud. Asset misappropriation includes embezzlement, internal theft, and skimming. For example, in 2010, the office manager of a small healthcare clinic in Hampton, Virginia, was sentenced to 3 years in prison for embezzling over $270,000 from her employer. She had been responsible for payroll, accounts payable, and general bookkeeping when she used her position to disguise payments for personal bills, the bills of others, and credit card charges as expenses from legitimate vendors. A payoff or kickback is a form of corruption when an employee accepts cash or other benefits in exchange for influencing a purchase or future purchases at a higher price. For example, in 2013, an airline fuel supplier was arrested for paying the vice president of a charter carrier service in Rockford, Illinois, over $200,000 in the form of checks, wire transfers, gift cards, and cash in exchange for fuel supply contracts. In cases of financial statement fraud, upper management is commonly responsible for improper revenue recognition, falsification of expenses, overstating assets, manipulation of liabilities, and improper disclosures. For example, in 2011, Green Mountain Coffee Roasters was involved in a class action lawsuit for concealing inventory in a vendor's storage facility. Reduced inventory balances and phony sales orders led to overstated income and increased sales of stock. Once the fraud was discovered, inventory numbers soared and profits fell, causing huge losses to certain investors. Businesses with fewer than 100 employees have a higher risk for financial fraud because they are less likely to institute basic anti-fraud or internal financial controls. In fact, the American Certified Fraud Examiner's report states that the median loss for a small organization that experiences fraud is $147,000 from billing scams, corruptions, check tampering, skimming, and false expense reimbursements. In addition, the average loss due to one instance of financial statement fraud is over $1 million. Sadly, fraud in a small or family-owned business is typically committed by an employee who is in good standing, has worked with the company 4 or 5 years, and is a first-time offender. The high level of trust given to these employees enables the fraudsters to hide their activities, and fewer than 20% of fraud-related activities in small organizations result in punishment, termination, or criminal charges. A fraud that costs $100,000 can easily cause a small business to close its doors. Therefore, it's extremely beneficial to invest in fraud prevention measures rather than waiting and spending money on detection, investigation, and attempts to recover losses from fraudulent activities. An ethical corporate culture diminishes instances of employee fraud and theft and encourages employees to do the right thing. Employees are less likely to commit fraud when they feel that management embraces corporate values, models ethical behavior, and enforces rules in a fair and consistent manner. Implementing effective internal controls deters fraudulent activity because internal controls are designed to detect and prevent errors, misappropriation, and non-compliance in financial transactions. Inadequate financial controls give employees room to manipulate financial transactions for personal gain. Anti-fraud education and a fraud hotline for anonymous tips are key components of fraud detection and prevention, since they encourage whistleblowers and decrease monetary losses from financial fraud. The occurrence of fraudulent activity will be avoided if small or family-owned businesses incorporate an ethical corporate culture, internal financial controls, and an anti-fraud training and reporting program. An ethical corporate culture is more than just the carefully written values statement and ethics codes put into place by management. It is an environment that makes it easy to do the right thing and makes it difficult to do the wrong thing. It is important to create a positive and ethical tone from the top of the organization, where managers and company leadership embrace corporate values, model ethical behavior, and enforce rules in a fair and consistent manner, or employees will lose trust and lower their own ethical standards. Furthermore, ethics only become embedded in the workplace culture when managers respect employee rights, pay fair wages, and give equal promotion opportunities. A study of over 12,000 workplace employees concluded that dissatisfied employees are more likely to engage in fraudulent activity. The fraud triangle integrates factors such as personal stress with motivation, rationalization, and opportunity, which work together to contribute to an individual's implementation of a fraud scheme. Motivations for committing financial fraud include greed, financial pressure, and employee disenfranchisement. Often, employees who feel underpaid and unappreciated believe that they are entitled to more compensation, or they rationalize that they are only borrowing the funds and will repay the company later. Fraudsters will perpetrate the fraud to meet financial pressures as long as there is a perceived opportunity to commit the crime without being discovered and the ability to rationalize their offenses. Fortunately, other studies have shown that financial success and motivated, productive employees are the results of an ethical corporate culture. Research also indicates that a healthy work-life balance leads to ethical decision-making and fewer experiences of employee theft and fraud. According to HR Magazine, misconduct is described by only 20% of workers when the ethical culture is strong. In comparison, 88% report observing misconduct in organizations with weak ethical cultures. An internal control provides a reasonable assurance that fraud will be prevented or detected before huge losses can occur. Most effective internal controls incorporate separation of duties or assigning different people to various financial tasks. Preventing fraud starts with the hiring process. Small organizations should carefully screen job applicants with a background check, as well as verify education, past employment, and references before tendering a job offer. Also, knowing your employees is often overlooked as a critical internal control. Management should be aware of any variations in behavior at work, such as changes in employees' lifestyle, employees who live beyond their means, and employees who don't take vacations or are possessive of their work. Moreover, it is understood that good financial controls have a system of checks and balances and require proof or original documentation prior to authorizing a transaction or signing a check. One helpful internal control is to secure blank checks and signature stamps in a locked cabinet and deposit all checks in cash daily. Another is to use sequential numbering systems for checks, purchase orders, and invoices, as well as regularly check for missing documents. Also, internal controls should ensure that expenditures are approved by both a manager and someone in accounting. In retail businesses, it is necessary to monitor cash transactions at the register and the inventory storage area with security cameras. Another beneficial internal control is for the owner or top executive to scrutinize and reconcile monthly bank statements in a timely manner. Conducting surprise internal audits is a valuable internal control because the employee doesn't know what is coming and doesn't have time to alter the records. External audits are the most frequently utilized control procedure. However, they only detect about 3% of the frauds and should not be relied upon by business as the primary fraud detection method. Finally, management should draft a simple fraud policy communicating that fraud will not be tolerated and what actions will be taken if fraud is discovered. Whistleblowers are one of the most effective means of detecting fraud in an organization. A whistleblower is someone who reports observed misconduct. Often, whistleblowers have to go outside of the organization to report fraud or misconduct due to fear, company inaction, or both. Unfortunately, HR Magazine says that 1 in 5 whistleblowers suffer some form of retaliation for reporting misconduct. Of those who don't report wrongdoing, 1/3 says it is because they are afraid of being punished. In the past, whistleblowers were considered disloyal or self-serving. However, executives should consider whistleblowers an asset to the company and try to motivate more employees to report fraud while assuring them that the fraud reporting system is effective and safe. The good news is that reporting rates are higher at companies with a strong ethical culture, and employees believe that ethical conduct will be rewarded. There are 2 actions organizations can take to detect and prevent fraud: conduct fraud awareness training and provide employees with a means to report suspicious activity. An anti-fraud policy and training program helps educate employees about how to recognize fraudulent activity, how fraud harms everyone in the company, and how to report suspicious activity. According to the ACFE 2012 Report to the Nations, businesses that have anti-fraud training programs experience fewer and less costly instances of fraud. In addition, a hotline is an effective fraud reporting mechanism. Therefore, it is smart for small businesses to establish a third-party fraud hotline service so employees can report suspicious activity anonymously, since most fraud is discovered through employee tips. Organizations with less than 100 employees are more likely to be affected by fraud because financial losses often force them to close their doors. Therefore, anti-fraud efforts at small or family-owned businesses should focus their efforts on cost-effective methods such as setting an appropriate ethical tone, effective internal controls, employee education, and a fraud reporting hotline. I would enjoy answering any questions you may have at this time.